Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
All good in the hood, Joe. Just, typical day in paradise over here in the Seattle area. And I use the word paradise because I guess I'm trying to live vicariously through you because you actually are in paradise today. What you up to?
Whew. Yeah, we're on the big island of Hawaii for the first time and exploring Volcanoes National Park, which is really cool. Although they don't have flowing lava anymore, but it is fantastic here. I was actually thinking that I wouldn't like the Big Island as much as I do, but I really enjoy all of this crazy like lava rock and whatnot that's around.
Yeah, it's weird. I always think of Kona on the Big Island where you're at. It's kind of like, when you're in school, like algebra and geometry. You either like or are good at algebra or geometry. I sort of feel that way with Kona. You either like Kona or Maui or Kona or somebody else. Sometimes I'm not that into Kona myself, but I have frequented down at the Hilton Waikoloa. I wouldn't say frequented. I've been to the Hilton Waikoloa, which is down there in Kona somewhere. Somebody in my family got married there.
Oh, cool.
Yeah. So I should probably tap into that person for a little private money investing because they threw quite a shindig out there. But where else are you going? You're staying there for a bit and then what?
Yeah, then we'll head over to Maui this afternoon. And when we're in Maui, we're going to go to Haleakala, and that's our number one goal there. And as I've heard, maybe hook up with some of the bigger pockets guys, which should be interesting.
Oh, yeah. That'll be super. Brandon Turner's over there, yeah?
Yeah, I was just talking with our man Tarl yesterday, so he was telling me that I need to hook up with those guys. So we'll see.
For sure. Awesome.
Do that.
Well, Haleakala, that's awesome. I actually, there's a sunrise. This is the difference between me and Joe, guys. There's a sunrise thing where you can go up to the top of Haleakala and they drive you up there, and then you can ride cruiser bikes down after seeing the sunrise. But you and Emily probably run up there and then jog down or something. You guys are so crazy. I can't even imagine what you're gonna do. But hey, I have some really good restaurant tips for you. Are you guys staying on the? Are you on the which side of the island are you going to be on in Maui? Are you going to be on Wailea or Kaanapali side?
So we're going to be in Pukalini at first and then Lahaina after that. So we kind of split up our time.
I don't know where Pukalini is.
It's up near Haleakala. It's like close, so we'll be able to get in there quickly.
Well, I'll tell you that some of the best restaurants are in Kihei. And if you want to go to a awesome sushi place, there's a place called Sansei Sushi over in Kihei. It's the best sushi I've ever had in my life. So don't get me started right now because it's only 9:45 or so in the morning. But, we start talking. I start thinking about like pulled pork sandwiches and stuff like that. And I don't want to rush through our awesome podcast today because we are going to get schooled. It's that time of year, right, guys? It's coming up to tax time, so we thought it'd be a great time to have an accountant that is with us today, Natalie Kolodij. Is that right? Kolodij. I told you I was going to get it wrong.
Kolodij.
Kolodij. You know what I did? I made a note. And I didn't make my little ampersandy thing to give me the little ka part right. So my bad on that. Well, Natalie, what's up? Thanks for joining us.
Yeah, thanks, you guys. Thanks for having me.
Awesome stuff. Some of you may have come across some of Natalie's sweet wisdom on taxes and real estate investing as a member of WARI, one of our favorite local real estate investment forums, I guess we'll say, online. If you're not a member of WARI, which is Washington Real Estate Investing, make sure you jump on there on Facebook and you can do a search on Natalie and you can see all the cool remarks that she's made that are super insightful in regards to taxes and investing. Maybe she's got an advantage over us. She knows all the ins and outs of how to save money and make money, being both an accountant and an investor. So we are stoked to have you with us today. And where are you coming from? Where are you at today, Natalie?
I am in Charlotte, North Carolina.
Charlotte, North Carolina. I have been there once myself. Beautiful, beautiful part of our country here. Are you plugged into some real estate investor groups out there as well?
I am. That was a big part of why I moved down here. It's kind of a great market. We're surrounded by a lot of awesome markets, so kind of a good spot to be based out of.
Yeah. Did you move down there as purposefully for surrounding yourself with good pickings on real estate, or some other reason?
I wanted to be kind of in some better markets for multifamily, and a little closer to cruise ports because I go on a lot of cruises. So those were kind of the two factors, but real estate we'll put first.
Wow. Good stuff. Well, I'm going to give you a quick overview of Natalie out of, what I'm going to tell you, and then she'll jump in and tell us all the details about how she got started in our great real estate investing biz. But if you want to learn more about Natalie, you can go to, now I'm going to butcher it again. So how do you say your last name again?
Kolodij.
Kolodij. Go to Kolodij Tax and Consulting, but you know what? We better spell it because that does not work. It's Kolodij, right?
Yep.
So Kolodij Tax and Consulting, or simply, maybe this is easier, guys, go to retaxstrategist.com and check out all the goodness that she has on there. We'll remind you of this again at the end of the show, but just stealing right off your website there, Natalie, I'm going to say what you got there just to let everybody know a little overview. It says, I'm not just an accountant, I'm also an investor. Investing in real estate can be scary. Filing your taxes shouldn't be. Whether you're just starting out with your first flip or you're an established investor with a portfolio of rentals, you need a tax professional who can make sure you keep the most of your hard-earned money. That's our gal right here today, guys. So we're going to do a deep dive, see if we can help you out before the end of the year, getting ready for tax season. Let's do it. Kick us off, Joe.
Heck yeah. So Natalie, we love having you on the podcast, and we'd like to know more about the people that are on the show. So if you could take us back to, we want to know where you grew up, how you grew up, and then how that led you into this crazy world of accounting and real estate investing.
Yeah. Okay. We'll take a deep dive back. So real estate investing kind of came about sort of unplanned for me. I knew I always wanted to get involved with it, but I think like a lot of people, I always figured, well, I've just got to get some good job and just save money till I have enough money to buy a whole entire house. I didn't know anything about creative real estate or any of the strategies you could use. So that's why I went to college for business. And when I was in college for business, I really liked kind of the accounting and tax courses. I ended up going that direction and going through and getting my degree in taxation. And it kind of just overlapped me into real estate. Like I said, at that point, I knew I wanted to be involved with it. I didn't realize how. So fresh out of college, bunch of student loan debt, kind of a mediocre entry-level job, and one of those real estate gurus were coming through Seattle, right? So that was my chance to learn all about it. So I did exactly what you shouldn't do, and I went to the free weekend seminar on real estate investing and ended up paying for the 2-day course. I cannot advise enough against that. There's just so many better ways to get better information. But ultimately, that's what really kind of just opened up my eyes to the fact that there were all these different avenues to get involved with real estate and kind of the creative side of it and the networking. And that's just sort of what kicked me into the right direction. So, yeah, so I wouldn't recommend the guru, but if the guru is what gets you to actually do something, then maybe it's okay.
Right. I always say start by joining, your local real estate investment group, right? Or community, right? That's a great place to start and listen to what's working for people or what's not, or let them point you in the direction of all the resources they feel are valuable. And if you decide to jump on the guru stuff at some point later, when you can afford it,
Yep.
then go ahead and do that, because, there's some value. I actually met Joe myself through a Fortune Builders immersion event. So that changed my life, and, meeting him. And so I give some credit there for that, of course. But so were you already an accountant then, working as an accountant when you when you went to that immersion or that weekend?
Yep. I think I had just finished my first tax season, and I remember thinking, oh man, I cannot work 100-hour weeks forever. So I should really figure out real estate. And so that's why I ended up going to that weekend seminar. And I will say that, as you mentioned, make sure, like, down the road, if it's something that can help accelerate your investing and kind of you can learn from it and you can afford it, is such a big part. Because I remember sitting there and they sent us out for kind of our midday lunch break at this, guru weekend event. And the assignment, like the homework for your lunch break, was to call up your credit card companies to try to get increases on all of your cards so that you could have it available for investing. But then as soon as everyone came back in, what they did was pitch the $50,000 full course. And I just remember thinking how it was just one of the most kind of predatory things I'd seen. These are people who are trying to learn something new. And I just felt like it was kind of pitching it the wrong way and putting them in a bad spot. And so that was that course. And then a few weeks later, through a local RIA, I actually took a wholesaling course for like $38 and learned 5 times as much. So I'm with you that starting local. And
I'll tell you guys what, if you listen to podcast number 63 on our nuts and bolts of real estate investing, you're going to get a free education on wholesaling right there. Probably the biggest dive on wholesaling that you will find anywhere on legal wholesaling. So just a side note for you guys, if any of you wholesalers out there are listening. Well, that's awesome, right? So good experience. Well, I guess though, for anybody that did sign up for that $50,000 or whatever it is, they can write it off, or can they not?
Well, like with most things in tax, the answer is it depends. So if you've never done anything involving real estate and you pay for an education in real estate, it is not deductible.
Yikes.
Any education to qualify you for a new job or skill set isn't deductible. So do anything first. Do one deal first. Get involved in some way first. You have to be in the business to be able to deduct business expenses related to it. So if that education is starting you, you're in a bad spot.
That is the first time I've actually heard anybody say that. So right now, what are we? I don't know how many minutes into this podcast we are. Right now, if you're out there thinking about getting into real estate investing or doing any of that stuff, maybe you've been attending stuff and going to stuff for a while, but you haven't bought your first deal yet. That is such a significant thing that Natalie just shared with us there to keep in mind, because I don't remember hearing that ever through the guru stuff. But I haven't been attention to guru stuff for quite some time. But really good nugget to kick us off there, guys. That is. Let's jump straight into it though. Let's just keep going here. So we'll kick off with, we're going to go back and reverse into a little slower mode and get things rolling here. So let's talk about the different entities for the different types of real estate investing. Let's kick it off with that one. What do you recommend on that? What's the do's and the don'ts?
Yeah, so this is probably one of the most common questions I get asked. People call me up and what they want to know is what kind of entity should they have? And it's kind of this weird overlap because it's really a legal question, right? I'm not an attorney. I can tell you the tax implications of these entities, but you should also talk to your attorney. And I can tell you right now, the two of us are very likely going to tell you completely different things. We have kind of different prerogatives. So I think it's important to talk to both, see what kind of works for you without overkill.
I'm glad you're saying that, because real estate investing, everybody listens to podcasts or they read blog posts or they do whatever. And one of the things, being a big coach of real estate investors and brokers here, is it has become really apparent to me how personal everything about real estate investing and related to it is. There is not a one answer, one size fits all approach or rules to follow, because you really need to back into it, like you say, in your personal situation, with your finances, your family, all kinds of stuff, right? So glad that we are getting that brought up here in the beginning.
Yeah, it's really one of those topics where the answer is it depends, right? And so that's why it makes me a little bonkers, because especially on public forums, this and that, someone will ask, what kind of entity should I set up? What should I do? And someone will very matter-of-factly say, well, my accountant had me do this. It saved me all this money. This is what you should do. But what saved that person money could end up costing this person money. Or you have someone who feels that they need to have one rental or one LLC for every single rental. Well, their properties could all be $1 million vacation homes. And someone comes along who's buying $40,000 single families. They don't have necessarily the same risk. So it's a very person-to-person setup. There's no right or wrong answer. And depending on how you're going to structure and partner with other people, your plans for future growth, it's kind of all over the board.
Can we go into some details on that? Can we use some examples?
Yep. So for starters, I think kind of one of the biggest misunderstandings and something that comes up a lot is the single member LLC. So if you set up an LLC online with the Secretary of State or go through, a company that sets it up for you or an attorney, if you are the only person on it, just you, for tax purposes, the IRS basically ignores it. That's a state-based entity. So federally, you don't have a separate filing. We don't need to, there's no cost associated with filing a separate tax return. You do need to keep separate books and stuff like that, but it gets reported on your personal taxes the same way it would if you didn't have that. So if that's all you're doing, when people call me and ask, there's no difference on my end, right? Nothing's changing. You're pretty much good. It's just that's the separation legally. Yep. If it's rentals, it would be on your Schedule E. If it's for flipping, it would go on your Schedule C. But if you're the only person on it, we're good. Nothing has really changed with regard to your tax filing. If you add a second person is where it can get tricky. So 2 people on an LLC will create you a partnership. A partnership does have a separate filing requirement, goes on Form 1065. Everything gets reported there. So now you're paying, and you have 2 tax returns, essentially. One for all of your business activity, and then the income from that you then pay tax on and report on your personal return. Seeing as this is a Washington-based webcast, I will note that there's kind of a weird exclusion to that. So Washington's a community property state. So if the only 2 people on your LLC are yourself and your spouse, we can still disregard it. We can still pretend it doesn't exist, no separate filing, file like normal without an entity. Because Washington state views husband and wife as one person, essentially. So if you're in a community property state, you can put yourself and your spouse both on your LLC and not have to file a separate partnership return. So you kind of have an option there. But if you're not in a community property state, a lot of couples want to feel fair, I think, about their real estate investing. So they both want to be on everything. And now you're just creating extra tax filings for possibly no reason.
Right.
So just something to be aware of.
So what we're zeroing in on is extra tax return bills, right? Extra paperwork, extra hassles.
Yeah.
In regards to that kind of stuff. You still have to have your separate books and all that kind of stuff, but there's some savings in regards to tax returns. But do you know what a lawyer might say in regards to that? I always worried about, I had a single member LLC on something that I did a condo conversion on. Mm-hmm. Sorry, guys, talking about me. Sorry, guys. And I was so worried because, every condo conversion back in the day, this is like 2004 timeframe, would get sued by the homeowners association. It's just par for the course, part of what you expect. It's going to happen because lawyers out there that wait for the last minute and then sue, and try and go after, warranty of habitability and all this other stuff.
Yep.
And so I was worried because I was using a special strategy with, my partners in regards to all this. And I'll say, I had a single member LLC, and I was worried that because are you going to be using just your personal social security number on that versus?
You can apply for an EIN, so you can have most of your information off of there. So it'll have its own tax identification number, its own registration. The biggest problem I see with single member LLCs is people break that corporate veil. And what that is kind of that separation between you and your entity. That's what gives you some level of protection. And that's why you need separate books. And as soon as you start paying for business items personally or paying for personal items out of your business, you're intermixing the two. And so it wouldn't be too hard for an attorney to say, well, they're not really treating this separate. They're just treating it like an extension of their own bank account, and kind of break into that veil. Now, I'm not an attorney, so I can't give kind of details, but what I will say is over the years of doing taxes, I would say upwards of 70% of the books and records I look at have some kind of intermingling. So you want to be really careful to keep your business and personal expenses segregated.
Right. Exactly. So it's not necessarily that a single member LLC is bad. It's that we all screw it up.
Yeah. I think it's kind of human nature. I think people don't, you're at Home Depot buying stuff for your house. You need a few things for the rentals too. You just buy it all on one transaction. I think people just don't in the moment think about the impact it could have.
Right. So aside from, let's assume that we're all doing our books correctly and not doing that for purposes of discussion. So we have single member LLC or a LLC that's a partnership. I mean, we're talking about a tax return bill at the moment. And what else are we talking about? Like now we're diving down into, should it be an S Corp or not? Or what's the next layer?
Yeah. So at this point, there's no tax differential. That's the other thing I get asked a lot, or I see posts about a lot. I need to make an LLC so I can deduct or get this tax benefit. And there is none. There's no tax benefit to having just an LLC. It does nothing. I guess you can deduct your $200 for making your LLC, but that's your only extra benefit. So with your rentals, you would put them into either a single member LLC or a multi-member, a partnership, or a trust. The one thing I would say and advise against is be very, very cautious if you're putting rentals into an S corporation or a C corporation. You hear about S corps a lot for tax savings, but that doesn't apply on rental properties, so there is no benefit. And there can actually be some kind of tricky hangups where having it in an S corp can create taxable events that wouldn't occur if it was in a regular LLC, just a single member LLC or a partnership. So always kind of talk with your tax professional first. There's a couple instances where, like I said, with tax, a lot of it depends. So there are a few times when an S corp can be kind of a useful tool, but as kind of a umbrella rule, keep your rentals out of S corps and keep your rentals and your flips or your rentals and your wholesaling in separate entities. You want those categories separate. Your rentals are passive income, no self-employment taxes, preferential tax rates, and then your flips and your wholesaling are taxed like a business. There'll be self-employment income on there. So you want to keep those separate. Otherwise, we can't maximize tax strategy for either.
Oh, so good, guys. So good. So I bet you so many people are screwing that up, right? That they are using S corps for their rentals, right?
Yeah, and it can be okay. It's one of those things where it could be okay, but it's not in most cases helping you. And there's certain, if you need to refinance or if you want to use a 121 exclusion, there's all kinds of things like that where having that corporate involvement can just really mess up the tax situation. So just talk to your tax professional first and just make them aware before you do something crazy.
So one of the things that you guys should be taking notes on today, everybody that's listening, are great questions to ask your own accountant, in regards to see if they know what's up. This is a good, take some notes, and we're going to talk about that in a bit. But, and this is a good test to see if you're using the right person that's plugged into real estate investing, right?
Yeah. And
just as a side note, are you available for hire for people in Washington State, even though you're in Charlotte right now?
Yeah, I actually work with clients probably in about 38, 40 different states right now. Perfect. So I work with clients all over the U.S. I'm fully virtual. So
awesome stuff. So let's go back into that then. So, most people then focus on like, I need to get that S corp probably because of the self-employment tax stuff, right?
Mm-hmm.
And they're thinking of that first instead of thinking about, I'm going to refinance later and it might affect me, or passive versus active, right? Everybody thinks I just need an S corp and they lump it all together because it's kind of, I feel like everything that all the gurus and when we all started this back in, let's say, I started doing this back in about 2012 or something like that. And the conversation I've learned over time is backwards, such as I think people need to go into real estate investing, understanding, their borrowing capacity, which then can drive the bus for them in the direction on their real estate investing based on what they want to do. And what I'm listening here to you today is that, again, another backwards thing. People think about, self-employment tax, because I'm going to make all this money, but they don't think about like, when I need to refinance later or something like that, these entity structures might affect that. So this is a great conversation that we're having today. So can we even dive a little deeper? Like, what do you mean where you say it might affect you on a refinance if you have, if you are in an S corp for a rentals?
So when the rentals are taken out of your personal name and put into a commercial entity, a lot of people just do that with a quitclaim deed. They're just transferring it over. And so if you go to refinance now, you have to go into commercial lending, whereas if it was kept in your personal LLC or your single, like your personal name, you can transfer it back and forth without any kind of tax issue. But if you're trying to transfer your property out of your S corp to you personally to be able to refinance it with a residential loan, not commercial, that can trigger a taxable event potentially. So there's things that people don't think about of that nature, or there's a lot of people who like to utilize, especially when they're new, occupying a property so that they can take advantage of that primary home gain exclusion. If you live in a home for 2 out of 5 years, you can potentially sell it with no tax. So if you're doing that and you're moving in or out of it and it's in your personal LLC, no tax implication. But to an S corp, it's a taxable event to transfer into or out of potentially. So you just have to be aware. And also, almost no one should start with an S corp is another thing. Gurus kind of pitch this backwards. I see this a lot where people come to me and they have this elaborate setup. They'll each have an S corp. They're going to be wholesalers. They're going to make $1 million, and they haven't done a single thing yet, right? So now they have this separate corporate filing requirement. They have all this paperwork. They have this whole extra headache for something that isn't beneficial to them yet. So I think it's important to grow and adapt your entity structure as your real estate grows and not vice versa. You don't want to set up something you're planning to grow into in 10 years, but is costing you money today.
Exactly. So what would be, so maybe a good starter, can you go from then your regular LLC, that you're filing your 1065 on, husband, wife team or a couple partners. And then later, once you're cooking and once you know what's up and whether you're going after buy and hold rentals or you're going to be doing some wholesaling or flipping, at that time you decide, can you elect to do an S corp if it's beneficial at that time, right?
Yep, absolutely. So that's what I tell people. I recommend starting with either 1 or 2 regular LLCs, like a single member LLC. So if you're not sure if you're going to flip or buy and hold, you have one where your rentals are, and then you have one where you can move properties over, basically, if you think you're going to flip it. Like I said, the reason being we want to keep those two different types of income separate. An S Corp, the way most people get an S Corp is it's actually an add-on to your existing LLC. So the best way I can describe that is like if you buy a Mustang, it's a Mustang, right? Your LLC is an LLC. If you add the Shelby package or a Cobra package, that's an add-on. It's still a Mustang. So an S Corp is just an add-on to your existing LLC. It's a feature we're adding to it in terms of how you're taxed. So what that means is you can start with an LLC. If, say, this is your first year doing flips or doing wholesaling, you don't know how much money you'll make, you don't know if the S Corp will save you money or not, start with an LLC. And if halfway through the year you're knocking it out of the park, you're going to make $100,000 and an S Corp can help save you money, we can add that on with a late election. But if you start with it from the beginning, you're only going to make $20,000. There's a good chance it's going to cost you more in terms of paperwork, payroll, all of these other things than what it's actually going to save you in tax savings. So I normally tell people around $50,000 to $70,000 as kind of your annual income point. At that point, it makes sense to start talking about an S Corp. If you think you're going to make less than that for the year, it could actually cost you money.
Boom. Hey guys, I know some of you out there are thinking about paying $5,000 to have somebody set all this kind of crap up for you, or whatever the numbers are out there for these type of days. And guess what? Maybe you should just call Natalie and run it by her first, right? I mean, again, save your money, get some professional advice or some more than one opinion. Sounds like it'd be a great opinion to get to hear from Natalie on this. If this is something that you are in the middle of and haven't pulled the trigger yet on, or you're thinking about doing that, super good info. I have not heard anybody spell it out plainly like this, really in a long time. So, or ever really. So this is super awesome today. You guys are going to thank me later. Actually, you're going to thank Natalie. Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. Good stuff. So what about for, we have a lot of real estate brokers or broker investors, right? Which is sort of no different than having a flip or having a wholesale business, right? You just have brokerage income. Is that accurate, or what do you see for real estate brokers? Any extra tips there?
Yeah, that's a very kind of hard case of it depends, and talk to your local tax professional, because brokerage income is kind of an odd category. So the reason S Corps can potentially save you money, IRS gave them special rules that if you pay yourself a reasonable salary, the rest of your income doesn't have to be subject to this extra self-employment tax. Well, if all of the income coming into a corp was already earned as a commission, there's kind of an argument that that is your salary, essentially. So there can be hiccups if you're a broker. It depends on the state and it depends on the firm. So reach out for your personal circumstance, see if you can be set up as an S Corp and if that can save you money, or if there's another entity that you'll need to utilize in kind of a different strategy.
I'm missing that one. So because they're basically saying, well, you've already paid yourself everything. Is that it?
Yeah. So the argument from the IRS in some cases is basically that, well, in determining your reasonable salary, you've kind of essentially already earned a salary. It was just in the form of commission. So how can you say that not all of that is subject to self-employment tax? Oh. So we've got to just be kind of careful on that subject and look at kind of the state and local tax court rulings and sort of how it's been handled there.
Gotcha. Makes sense. They're saying, oh, you can't pay yourself a salary twice, right? Kind of like.
Yeah. Like how can you say it's a different number than what you've already earned, essentially?
All right. Good stuff. Man, we could go on and on about that topic forever, guys, on the entity structures and strategies there. But let's keep going here. Let's start talking about what's next here. The new 199A deduction and rentals.
Yeah.
Let's talk about it.
Yeah, absolutely. So the 199A deduction, you guys hopefully have heard about it by now. It applied to your 2018 taxes. The reason they came up with this, so what this was as part of the Tax Cuts and Jobs Act, they lowered the corporate tax rate. They basically said, the smallest tax rate for corporations, we're going to drop that down. To kind of keep things fair with other entities, they said, okay, well then to make up for this, if you have a pass-through entity, which would be a partnership or an S Corp or a single member LLC or just rentals, if you have any of those things where you pay the tax on your personal 1040, we're going to give you this deduction. So it's going to be a 20% deduction on your net income from these sources. So it's just kind of level out the playing field. A lot of accountants, a lot of CPAs got this wrong. They got this really wrong. So what mixes people up is basically the concept of, is a rental a business, right? People think, well, it's passive income. I don't pay employment taxes on it, so it doesn't qualify. But these are two totally different sections of the tax code. So the nitty-gritty of it is that your rental can absolutely be a business. Even if you're not a real estate professional, even if it's not active income, it's not a, flipping or anything like that. If it's just a passive income, a normal long-term rental, it can still qualify as a business. There have been IRS tax cases where someone owned one single rental, one single family home, and the IRS ruled that was a business. The tax court ruled, that qualified. The reason being is because the law and how it's worded is very vague. It just says you need to continually participate in something with the intent of making money. So as long as your rentals are something you acquired, hopefully to make money on, to be a real estate investor, and it's not like, I inherited 4 properties from my dad, I just collect the rent checks, haven't raised rent in 12 years, I ignore them, I'm kind of a slumlord. Like if that's what you're doing, you're not really running a business. But if you're acquiring properties, you're being smart about it, you're trying to make profit, like if you're doing the real estate investing, that's a business. And so your rentals absolutely can qualify. There was a lot of confusion. Like I said, a lot of tax pros got this wrong. They kind of didn't grasp it. And so the IRS released a safe harbor for this, basically an election you could make. That's kind of a series of hoops to jump through to sort of check a box to, yes, you qualify. Like if your tax pro isn't competent enough to decide you do based on their knowledge, here's an easy out. But that easy out is far worse for investors. Like it is so impractical and there's so many circumstances that can disqualify you that I think it's one of the worst things that have been released in recent years. So my advice to you is ignore that safe harbor. If your tax professional in 2018 told you you had to meet those requirements to get this deduction, kick them to the curb. They didn't know this well enough. And I actually have a chart I can upload to you guys that kind of runs through qualifying both ways that shows why it's more simple to use it without the safe harbor.
Awesome.
Yeah, so I can send that and you can add that to the post perhaps. But yeah, rentals qualify most of the time.
So that is interesting. That leads everybody to going like, oh crap, I don't know, I could have done that.
Yep.
So let's talk about that for a second. Like, what if people are realizing that they hired the wrong accountant at this point in the podcast and they want to do a revised tax return? Is that something that's advisable, doable? What's the story on that?
Yeah, you can amend your taxes if there's errors on them for 3 years where you can still get a refund. So this 199A deduction is kind of the biggest thing when people ask online, what should I ask when I'm trying to find a tax professional for my rentals or for my real estate? This is the question. Like, ask them if you can take this 199A deduction on your rental. If they say no, or if they bring up the safe harbor, I would say they're not specialized in real estate. And if you'd like right now, I can tell you guys what lines on your tax return to look at to see if you received this correctly in 2018. You want me to?
God, let's do it.
Let's do that. All right. So what it comes down to for this deduction, we're going to assume for simplicity, all you have is rentals, right? We don't have any other business income, nothing else. We're just talking about rentals and this deduction. So your rentals are reported on Schedule E, and this deduction applies only if you had rental income, right? You need business income. So if your rentals all generated a loss, you won't have any benefit from this year, right? But if your rentals had, after all of your deductions had income, you qualify for this 20% deduction on that income. So if you look at your Schedule E, that is where your rentals are all reported, the very bottom line is line 26, right? That shows you the total of if you had real estate income or losses. If that number is positive, if you had income for the year, you should qualify for this deduction. Like I said, assuming no other involvement, no other businesses. So then if you go to your 1040, the main front page of your 1040, on line 9, it lists the qualified business income deduction. There should be an amount there. If you have a positive number on that final line of your Schedule E and no number on line 9 of your 1040, you should call up your tax professional and ask them if there's a reason you did not receive the 199A deduction.
Boom! Guys, geez, so awesome, Natalie. Man, I'm geeking out over here, and I know you guys are too. This is absolutely fantastic stuff. Let me ask you, just in case anybody's wondering, is there do you have to like track your hours and your stuff? Is there any connection with that, or you don't have to?
Yeah, you don't have to. Only if you're going by that safe harbor. The safe harbor had a bunch of provisions, basically. You couldn't have residential and commercial real estate together. You couldn't have occupied the property at all. You had to keep separate books for each enterprise, and you had to track all of your hours. But like I said, if you can just prove that you're a business, that you are regularly involved for the intent of profit, then you qualify. So you don't necessarily need that safe harbor. You don't need to track your time. There's a few sort of extra steps I would recommend. If you're going to now say your rentals are a business, you've got to kind of walk like a duck, quack like a duck to be a duck. So always good to have a formal business plan, just something if the IRS ever questions you, you have that available to kind of back your stance. And also you might need to send out 1099s. Normally landlords don't have to, but if you have a contractor or anyone who does services over $600, providing those 1099s now also backs that stance that you are a business. You're acting like a business. You get this business deduction. You qualify potentially for a home office. So it's really good to have steps in place like that to really show that these aren't just something totally passive that you're not involved with. You're not managing them in any way.
So rad. You know what I'm thinking as we're talking about this is that I got a side biz product for you to sell that everybody would want, which is you should make an example of a formal business plan that kind of fits, like an outline or a template maybe that people could fill in or something like that.
Yep.
And if you wanted to do something like that, sorry guys, we're just talking biz right here in front of you guys. If you want to do that, I'll help promote that for you because you're sharing so much with us. We want to make sure, that we give back. So if you want to talk about that separately or you think that's a great idea, I'd love to help you on that. And I can really help you on that, I think. So in a big way.
Yeah, absolutely.
Let's talk about it. So rad. I have Goosey's here. I'm using the J-Lo says the Goosey's out. Right. But let me ask you now, let me back it up for a second. So we're ideally able to ignore the safe harbor if we are able to check the boxes that we just discussed, which are not hard to check. When would we need to? Who are the people that need to stick to the safe harbor stuff and comply with that?
People with bad accountants
on board that do all kinds of stuff, right? So maybe even commercial. And when do we need to stick to that?
I would say never.
Never.
Yeah, I don't think, before they came out with the safe harbor, I was saying that people could take this deduction for their rentals. If your rental is a business, it's a business. Like the IRS could try to argue it, but I have a folder of probably 20 tax cases that relate to this where the IRS ruled that rentals qualified. So historically, even though they don't want to put sort of a bright line test, they lean towards, allowing it. So if you're treating your rentals like a business, I don't know about you guys, but I'm involved in real estate to make money, then you should be good. Your accountant should be comfortable and confident enough to kind of put that case together and put those, like I said, the kind of evidence together, like the business plan, the 1099s, so that if it's ever questioned, you can argue it. But to me, the safe harbor just adds more of a hindrance than any kind of benefit. It's sort of a lazy way out.
Right on. Now, what about Airbnb? What if you are basically co-living? Here's some buzzwords: co-living, and the Airbnb stuff. What if you're using your own personal residence for Airbnb and collecting income off there, but you live there? Is it no different than having a duplex and living in one of the units?
Potentially. So when you rent part of your primary home, if it is within the walls and you have shared space, we've got special rules. We're not allowed to depreciate kind of those shared spaces, versus if it's a duplex and they've got a completely standalone unit, all day long we can call that a business. If you're kind of renting rooms in your house, I'd say we have to look at it a little more and really see if you're kind of just having roommates just cause, or if this is really part of a business plan. If you, like I said, you've got to kind of lay out the steps. If you literally lay out a business plan saying, doing this is allowing me to put this much money into a savings account. This is allowing the funding of this purchase that should happen first quarter 2020. If you're treating it like a business, you're in a much better position to defend.
Awesome. So what a co-living, because that's a big buzz right now for those that can do that and want to jump into that. Would a co-living business plan versus a, regular rental property business plan look different?
I would say so. I think any business plan should be fairly customized.
Yeah.
So it can look a little different. I think you're going to need to work a little harder to show that it's a business. But I think it's doable. It's kind of, like I said, case by case, but talk through it with your accountant, see if you're in a position where we can make that argument.
Awesome stuff. Well, let's keep cooking here because I'm so excited. Like I said, this is my wheelhouse. I could geek out with you forever. I don't know if we've already covered or not, but what are some top mistakes or 5 mistakes you see most often that other tax professionals make when it comes to real estate investing?
Yeah, the big one this last year was the 199A. So we kind of covered that. But as I'm talking to clients coming on board for this year, a lot of people kind of miffed this up last year. So that's why I said check those 2 lines on your taxes. Another thing I see quite often that seems silly is on your taxes on Schedule E, there's a little box at the top for each property that says fair rental days. And that's how many days your rental was available for rent. Seems pretty simple. a lot of accountants are pretty lazy when they're working those long hours and just trying to rush through things. And they either default to 0 or they leave that box blank, or they drop in 365. They don't ever actually calculate how many days your rental was a rental. Well, if you go in for lending and it shows that your rental only made $300 for the year and it was available all year, that looks like a terrible property. But if you had only owned it for 4 days out of the year, it's not. So it's really important to make sure your tax professional is filling that in correctly so that your lender has accurate information that shows your property in the true light of how it is in terms of, how profitable it is.
Awesome stuff. Good tips. Little ninja details. Julie likes the ninja details.
Yeah. One of those little things, but I see it all the time.
Anything else?
So,
any other?
Yeah. Another thing I see wrong a lot is on depreciation. This is a big one when your rental is first set up. So those who don't know depreciation, basically the IRS says you have an asset for a long time. As it gets older, it should go down in value. So we're going to let you deduct a little bit of the value every year. For residential rentals, that's 27 and a half years. And the depreciation only applies to your building, not your land. Land doesn't depreciate in value. It's land. It's going to be the same thing in 100 years. So something I see mistakes on a lot is that setup where either the prior accountant didn't separate out land, so you're depreciating too much, you're taking too high of a deduction, or I see quite a few properties where there is no depreciation at all. There's this misconception that, so when you sell a property, you pay some tax on kind of related to the amount you took of depreciation. So there's this misconception that if you don't take it, you won't owe that tax, but that's not true. The tax is due whether you took the deduction or not. The IRS is going to calculate it based on as though you did. So you absolutely want to take depreciation and you want it to be as advantageous as possible and set up to give you the best deduction. So if you don't have a separate amount listed on your tax return on a depreciation schedule for land, or if your tax professional just said, oh, we just always use 80-20. We just put 80% to the building, 20 to land. That won't ever hold up an audit. That's kind of one of those like lazy accounting firm things I see pretty regularly.
All the time, yes.
Yep. And it's unfortunate because this is somewhere we can really kind of put some strategy in when we're setting up the property, and you only get to do it once. So there's 6 or 7 different ways the IRS has accepted for your basis, for the amount you're saying you get to depreciate. The 2 most common are what's on your appraisal, how much the appraiser said your land versus your building was worth, and then the tax assessor's percentages to each. So those are the 2 most common, but there's a couple others too. But if your accountant isn't looking at that or seeing which of those options is better for you, they're not putting you in the best place. They're not, kind of putting any thought into making sure you get the best deduction possible.
Right. Is there one that you see seems to lean towards a better number? Meaning we want a higher land value, right?
Opposite. Higher building, so you have more to deduct each year. So you get a bigger deduction.
Sorry. Yeah, right. Sorry.
Yeah, so I don't see one leaning more than the other. I always say, though, that as you're looking at deals, I would never make or break a deal for taxes. But if you're looking at kind of 2 properties and you're trying to decide, they're maybe really similar, you're trying to decide which one to close on, check out the tax assessor values, because they could be 2 identical houses. They're going to cash flow the same. But if one has 80% value to building and one only has 50, you'd be getting a 30% lower deduction for no reason, just because different tax assessor, different zip code, whatever the case. So it's always worth kind of looking at just to see what you're setting yourself up for.
You don't happen to know any great tax appeal consultants in Washington, do you?
I don't.
I'm going to work on that for you guys. We'll have somebody on the podcast on that. Awesome stuff, man. Good nuggets dropping today, guys. Let's see. What's this? We were talking about amending returns. I'm looking at some of our notes here on the podcast here. Is there a form? Do we need to mention form 3115 for depreciation errors, or do we kind of touch on that right now by what we just talked about?
Oh, yeah. So basically with depreciation, this is a weird thing that comes up a lot. So with depreciation, if If it was done wrong for 1 year, if they didn't separate out your land at all, we can amend the return and fix that. If it's been multiple years, you have sort of set an incorrect pattern with the IRS and you have to file a special form to correct that. And that is that form 3115. So if you notice that error on your taxes, this is a pretty beefy form. I wouldn't recommend trying to undertake this yourself. So if you notice that your accountant didn't separate out your land or you think your depreciation is wrong, reach out to a tax professional and inquire about getting that straightened out and fixed. Because like I said, it continues on forever, right? It continues on the whole time you own that property. So it's going to be wrong every year. You can't just change it the next year. You need to correct it properly. And when you sell, if you didn't take depreciation, you're going to be taxed as though you did. So you really want to make sure that that is in place and, not going to cause you any headaches down the road.
Excellent stuff, guys. Let me ask you a question about, do you ever see any mistakes related to seller financing or being a private lender? I'm not exactly even sure what I'm asking you, but is there anything related to that kind of thing that you see tax related that we need to watch out for? And if you're a private lender and you're collecting interest off of, one of your real estate investor buddies that you loan some money to, do you need to issue some sort of tax document to that borrower as a private lender?
Yeah. So what I see kind of the biggest misconception is someone will say, oh, we're going to seller finance. We're not going to do any interest. We're just going to spread out some payments on principal. The IRS doesn't allow basically an interest-free loan like that. So they're going to apply or have your accountant apply the current federal standard interest rate. So it really takes some control away from you in terms of how your deal is structured. So they're going to impute an interest element to that deal, basically. So it's important that when you're setting up a seller financing or an installment sale or anything like that to actually set up an interest portion. So the person doing the financing, if they need to issue, so normally if you have a loan through your bank, you receive your 1098, right? That tells you how much interest you paid for the year. That's only required to be issued if someone is in sort of the business of lending. So if this is a hard money loan or a private loan and it's someone, this is what they do full time now, they should issue that 1098. If you're just kind of financing a deal for a friend, you want to get involved with real estate, you didn't know how they wanted to partner, you loan them $50,000 kind of thing. You don't necessarily have to issue that 1098 because you're not in the business of banking. That's not your job. What it comes down to is it never hurts to issue a 1099 or something like that, even if you don't need to. It's just more information.
I mean, a 1098, right?
Yeah, sorry.
Okay, we get all confused. At least I got something right today, guys. That's it. At least I got something right today. Awesome. So the last thing we were going to talk about, are there any tips on how to be smart with your rental losses? And then we'll start wrapping up.
Yeah, this is another thing I think a lot of accountants don't really dive into. They look at rentals as sort of this ongoing, just sort of passive, collect your rents. It is what it is. There's not much thought put into it. Very few people, I think, talk to their tax professional throughout the years about strategy for their rentals. I know every CPA firm I've worked for, that was sort of the mindset, was like, this isn't really a business. We can't change much. They're just charging rent, With rental losses, rentals are passive. Your W-2s, your normal jobs, that's all active income. Normally, you can't combine the two. You can't use passive losses to offset ordinary income. There's a couple exceptions. If your income, your overall income on your tax returns is under $150,000, then you're allowed to use some of those losses up to $25,000. It's a small taxpayer exclusion. But if your income's over $150,000, people get upset because now they can't use those losses. It just rolls forward each year. If there's only passive losses and no passive income to kind of suck those losses up, they just keep rolling forward every year, right? And so people feel like they're not really getting the most benefit out of real estate. And what's important to remember is kind of two-part. One is that those losses never just disappear. So if you invest in a syndication that's passive and it provides good income, now you have something to kind of wipe out the taxable income with. So you can be making money, paying no more tax. But the other thing that's important to remember is in the year when you sell your rental, any of those old losses become available. So if you've had a $10,000 loss every year and 8 years later you go to sell this property, you've got $80,000 of losses that will become available. So rather than having to do a 1031 or having to look at something like that to sell your rental and not pay tax, if your gain is $80,000 and now you've got these banked up $80,000 losses, you can potentially wipe out most of your gain with your losses. So it's important to be mindful of that in terms of planning.
Your losses from another property.
So your losses from other properties, all of the previous ones won't become available. It's property specific.
Okay.
However, in the year you sell a rental, all of your prior losses from that specific rental become available, but also any losses from other rentals generated during that year are also available for your use. So what this means is that if in 2021 you want to sell a property, you don't want to deal with a 1031 exchange, you just want to sell it, get the money. You have some banked up losses here, and say you have 3 other properties. There could be some expenses that you can choose to kind of defer until 2021 so that those other properties can have the biggest losses possible that year so that we can wipe out your gain. So if you're thinking about going to a real estate event, going to a big conference or something like that, or if there's some repairs you need to do that wouldn't need to be capitalized, we could expense them all in 1 year. So there's things where you can be kind of smart about your planning, where you can actually utilize these losses better than I think what a lot of people do, where you can sort of set it up. I tell people that with your taxes, with rentals, it's like playing chess. It's not checkers. You can't just think about your next move. You've got to think 3-4 moves down the road. So that's what this is. If you're just aware of what you're planning to do in the future and you're talking to your tax professional about it, you can get yourself into a position where there's kind of a better plan in place, where you're using those losses strategically and kind of saving your losses for a year where you can use them all up.
So awesome, you guys. This is like life-changing stuff today here for you guys. I got to tell you what, very awesome stuff. I have one last question. Let's say you're invested in a larger partnership or a syndication or something like that, right? Mm-hmm. And that you're just a limited partner or a member of an LLC or something like that. And when the property is purchased, a recourse loan is in place, right? And I'm wondering about, like, if you have a tax loss on a property that you are a partner, you have a membership of or partnership of, right? Mm-hmm. Whatever. And yet there's a recourse loan that you did not have to sign on yourself, but the larger partners or the sponsors did. And you have a taxable loss. Are you actually able to use that loss before, because of the recourse loan status, or do you have to wait until sometime later because you're not on the hook for the loan? Does that make sense what I'm asking?
Yeah. So you're likely still in a spot.
Say it more eloquently than I.
If you're invested in a syndication, if there's losses, if you don't have another form of passive income, you're likely still stuck where those are just going to get captured and rolled forward. This is another thing where I talk about kind of diversifying your portfolio a little bit. There are people who have properties where no matter what I do, I can't get them to a loss. People who are invested in these really good cap rate areas. If you're in the Midwest and your $30,000 house rents for $1,200 a month, like you're going to make money. Or short-term rentals cash flow much better. So if you've just got a bunch of rentals making losses, you can dive into something that's a higher cash flow, like a short-term rental or a different market, and then have some income that can use those losses each year. So you've got to, like I said, kind of bigger picture look at things.
Right. What about let's say somebody's invested in a syndication on a 200-unit apartment building, and for whatever reason, that syndication group put a recourse loan on it where they're personally on the hook, right? But yet the other partners are not. Does that make sense? Do you know what I'm talking about?
Yeah, it's going to depend on structure and if they're actually an active or passive investor in addition to the recourse.
Okay.
So the recourse is what will give you basis in your partnership. And that's another limiting factor of partnership losses. But there's kind of a few levels of when or if you can deduct your syndicate losses and what you can deduct it against.
We'll save
so it's
that,
kind of
save that for another day, guys, because I could ask her about 10 more questions that I probably need to write down my thoughts a little bit more clearly on. So, God, good stuff today. You know, I have one other thing that I want to ask you about, and something that I think I've noticed about you, just from basically stalking you online and so forth, which is, are you a dog lover?
Yes. Hopefully my mic didn't pick it up during this podcast, but I actually have a bulldog, a rescue bulldog, and she's snoring away next to me. So
awesome stuff, right?
Yeah.
So I've seen some of your posts before with your dog, which are hilarious, right? So we have a SIC team mascot here, my man Buddy, which is my Labradoodle. He is at my house and a handsome fella, but I have loved your. So if you guys are dog lovers, follow Natalie, and have some laughs there too. Do you do something special? Do you have like foster dogs or?
Yeah. So I foster for a bulldog rescue, and then my current dog was a foster fail where I couldn't give her back. So
well,
so
how's
I had
that
to keep
happen?
her. Huh?
Is that your choice, or do you mean the dog has bad manners or something?
Oh, no. They never tell you, no, this dog's too terrible, you have to keep it. No, I just fell in love with her. I couldn't give her to anyone else. So awesome. The goal of fostering is to find them a good home, but sometimes you get a little too attached and you got to keep them.
I hear that. Do you have any other podcasts or books that are your favorite, or what do you read or listen to religiously that maybe some of our listeners like to tap into as well?
Yeah, I'm kind of all over the place. Obviously, everything Bigger Pockets I try to keep up on. I listen to Alex Felice. He has the Broke is a Choice podcast. I listen to his pretty regularly. He's got some good guests. And gosh, off the top of my head, that's where I'm pretty regular.
Nice.
Yeah.
Broke is a Choice. I haven't heard about that one. We'll have to check that out. Joe will drop it into the show notes as well. So, well, guys, this has been outrageously awesome. We have a new friend in the squad, Miss Natalie here, and we hope to check in with you from time to time. Make sure you join us on the Seattle Investors Club Facebook page if you're not already on there. And we will blast your podcast here to the sun and to the moon and share all these great nuggets with everybody today that you've blessed us with. So great to have you. And Joe, where can everybody find the details?
Yeah, so the show notes for today are at seattleinvestorsclub.com/90. That's seattleinvestorsclub.com/90. Lots of good stuff in there. And if you guys are listening on your favorite place to listen to the podcast, make sure to hit the subscribe button because that is free. And if you wouldn't mind and you like this podcast, we'd love for you to give us a review, and we'll even read the review on the podcast. So that would be awesome.
Sweetness. And there's a little admin flavor on top here, guys. I want to remind you all, if you're listening, this is the kind of deep dive discussions that we have every week at Seattle Investors Club meetups. Those are every Tuesday and every Thursday right now. We do have our Kitsap one, not our Kitsap, our Skagit one kicking off here. So if you're not on the Seattle Investors Club Facebook page, make sure, or on our meetups for Seattle Investors Club, make sure you jump on there because we're going to be announcing our Kitsap, not Kitsap, sorry, I keep saying that, our Skagit County meetup pretty soon here, which is going to be in the evenings. We also do have a resource for you of a Kitsap meetup with our buddy Dave Billings. So we want to make sure that you guys are on our Facebook page and get that information as well. We'll be announcing it. It's once a month, I think on a Monday. But weekly, we have our weekly coaching and mastermind at Angelo's in Burien on Tuesdays from 12 p.m. to 2 p.m. You guys can just show up. You can stay the whole time. You can stay for an hour. You can do whatever you want, but it's awesome. And you definitely are missing out by not popping into one of those meetups. Our other one is on Thursdays on the east side in Redmond at the Family Pancake House off Redmond Way from 10 a.m. to 12 p.m. We'd like to see you guys there and come join the conversation. So that's it. That's all I got for you guys today. I'm going to be booking it down here to Angelo's to get my beef cannelloni pretty soon. And I look forward to seeing you guys in person, face to face, one of these weeks at one of our local meetups. So over and out. Joe, aloha, mahalo, be safe. Natalie, give your dog a kiss for me, and we'll talk to you guys again.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.